And this is something that I think a lot of people learn the hard way, and it takes really, really long time investing and trading to understand. And that is understanding, buying the dip. They're right back to where they were at the top of that last earnings off of one. Now, that does not mean you should buy Palo Alto options for 2 weeks out or a month out or a year or buy shares. I don't care. It's up to you. I own this. I've owned it for a long time. So even with this drop, I'm fine. Okay, I'm fine. I have a little less in gains than I had, but I'm still up significantly. I think this is another opportunity like with FTNT and Palo Alto last time to buy the dip on Cyber, the ETF. I bought some shares this morning. Even though I'm up 18% on it overall, even with the 6% drop today, I don't care about the percentage on my P&L. I care more about the profit and the amount of capital. So when I buy the pullback, and this is something that I think a lot of people learn the hard way, and it takes really, really long time investing and trading to understand. And that is understanding, buying the dip. A lot of people think, here's a problem when you hear buy the dip. When somebody hears the word buy the dip, there's three types of people out there, okay? There's three types of buy the dippers. There is the FOMO buyer, okay? This is the I missed it last time, so I'm going to buy it this time, okay? I missed the last dip, so I'm not going to do it again. So they buy the dip just because they remember the last time they didn't buy the dip, so they're buying this dip, all right? That happens with markets. That happens with different stocks. The problem with FOMO dip buyers is that they could be buying a dip on something that's going to keep dipping, but they're not focused on why it's dipping. They're focused on, I missed the last time it did this, so now I'm going to buy this one. But this dip might have been because the market. This one might because have been the stock. So that's your first type of buy the dip person. Your second buy the dip person is your DCA buy the dipper, right? This is the smartest buy the dip type of person. This is, I'm buying the dip because I believe in this long term, and if I was holding it at $300, whatever the stock is, a share, even though I bought it at $200, if I'm still holding it at $300 because I believe it's going to $600 one day, then of course I'm going to buy the dip down to $270. Sure, it's going to mess up my P&L percentage because instead of being up 50% when it gets back to 300, because my cost basis is going to go to 235, I'm only going to be up, 30%. There are people, and some of you guys are guilty of this, and it's fine. I went through this phase where you are legitimately not going to buy it because it's going to mess up your percentage, my average cost. But instead of having $2,000, and when it gets to 600, it's 6,000, right? I would rather be invested at, hold on, I got to mute real quick. You always do this in the middle of segments, okay? And so what happens is you look at your P&L and you say, oh my God, I'm already up at 270. I'm still up 35%, right? I'm up 35% still. I was up 50%. I'm up 35% now. If I buy here, it's going to lower my percentage of increase. So you won't buy. But if you're holding at 300 because you believe it's going to 600, why would you not buy at 270? If you still think it's going to 600, that just means the shares you buy here are going to be worth more. But people won't do that. And that's something that we see along the time. You'll do that with the total market, but you won't do it because you don't want to mess up that percentage. You want to focus on what that percentage gain is, not the dollar amount gain, right? So if you had one share here and it's at 300, you're up $100, right? You're up 50%. You have two shares, all right, for $470. Then when it goes back to 300, you're up $130. When it goes to 600, you're up $400 on this share, and you're up $330 on the other share. You got to think long term. So instead of being up $400, you're up $730. I would rather be up $730, and that means I'm up 250%, than being up 400 but having 300%. Which one would you rather have? My gains are 300%. Or sorry, 200% and 150. What would you rather have? To be able to say I'm up 200%, $400, or I'm up 150% and $730. Especially if it's something you're holding long term. If you're holding this for 10, 20, 30, 40 years, who cares? All the people who didn't buy the dip during COVID or didn't buy the dip in 2022 because they're like, oh, well, I don't want to mess my percentage up from what I got pre-COVID. They messed up on so much money because you're dollar cost averaging. And the third type of buy the dipper, this is the most dangerous buy the dipper, and this has led to more missed gains and more missed wealth than anything in the world, and that is the I will buy when it goes red. I will not average down on my position until it goes red. I'm going to give you two scenarios. Number one, millennial coming out of high school, 2003, doesn't have any money, gets a job, starts investing. 2007, oh my God, I love this investing thing. This is great. Crash happens, right? They don't know where the bottom is. They don't dollar cost average. They freak out. They wait. Starts going back up. I was up 40%. Now I'm only up 5 or 10%. I should have bought the dip. That's okay. I'll wait for the next pullback. Still waiting. Oh, no. The next real pullback happened here. 150% between here and here. They're not going to buy that pullback because they're not red on their positions. Okay? There are people out there who bought here, okay? Or bought here and bought the dips. Even the people who bought here were buying here or here and kept buying. Some people bought in the 90s. This is how the market is crazy for you guys. This is for those of you guys who really want to think about this. I'm going to tell you, how many of you guys are 35 or younger? If you're 35 or under, I want to see like a number. Just give me a chance. Okay, okay. All right. So a good percentage of you guys. I didn't ask you to put your age, but okay, 35 or under. Okay. The only reason I'm saying 35 and under is because I want to give you an example. In 1994, that was 30 years ago. Goes by quick, doesn't it? Goes by real quick. So for those of you guys that are under 35, 30 years ago, so you're technically supposed to retire 30 years from now, right? If you're 35. If you're under, you have even more time. If you put money in the market in 1994, right? The 1999, 2000, 2001 dot-com bubble, you were up huge. You're right back to even. In 7 years, you're at 0%. You didn't add anything, you left it there. 7 years later, you were back up big. 14 years later, because you didn't buy any dips, you're still even. You were 35 years old in 1994. 7 years after you started investing, you were back to even. That sucks. That sucks. But what did I tell you guys all the time? Stop looking at your long-term portfolios, just dollar cost average, set up reoccurring buys, and forget about it because this is long-term and always buy the dips, right? 7 years later, you're back to break even. I'm never going to retire. If you're under 35, you want markets to crash because you could have bought all these dips, but whatever. 14 years later, the next market crash happened. You're back down to 0%. You're going into retirement this year. You didn't buy a dip. You didn't do anything. 14 years without making a dime. But you don't make shit till you sell, so you didn't really lose anything either. 14 years. Zero return because you didn't buy the dip. But now, you were 35 in 1994. It's 30 years later. It's 2024. You just turned 65 years old. You're going into retirement. Let's say you went the safe route and bought the S&P 500.
Welcome LMI23 to the Bear Gang. Holy 32 months.
You're up 1,157%. You added money. You didn't add another dime. 7 years later, you were at 0%. 14 years later, you were at 0%. You didn't do anything. You just waited. 14 years seems like a long time, but let me tell you all something. 2010 was 14 years ago. That's quick. This is a nice game if you can time the market. Oh, you want to be that guy. I didn't time the market. I'm giving you a 30-year time frame. Okay, let's play your game. Let's say you had the worst time. Now, remember, if you bought the dip, you're not up 1,157%. You're probably up 600%. But instead of being up 1,157% of $1,000, you're up 600% of $10,000 because you added money all the way. Now, I ain't no math nerd or no math genius, but I can tell you right now, 1,000%, 1,100% of $1,000 is a lot less than 600% of $10,000. Now, to my man who said, well, that's just because that person had perfect timing. No, 1987 bottom would have been better. Okay, you bought January 2008. Okay, and you never added a dime. Guess what? 2 years later, you were down 57%. And you were too stupid to buy the dip. You're too scared. You had the absolute worst timing of any single person in a 20-year span. No one had worse timing in that 20 years than you. You were the unluckiest to start a portfolio in a 20-year span. And you didn't buy the dip. You're up 240% almost. If you add in dividends, probably more. My wife says I give her a headache with all the numbers I deal with. It's too early, and good morning. I give my wife a headache just talking to her, so you're good. Now, if you put $1,000 in at the top of the market in 2008, never bought another dime, you're up 226%. But back to the I'm only buying if I'm red. Let's say you added once a year for 10 years after that. Now you've got 10,000 and you've got a higher percentage return because you bought on the way down because you started at the top. So for all the people that say, Stocky, I'm afraid to start investing, or I'm afraid to start buying now because what if this is the top of the market? Good. You cannot lose. You cannot lose. If you start buying now and it's not the top of the market and it keeps going, you're in all the way because you're not waiting for the dip. So you don't miss out on all those gains. And if it is the top of the market, the perfect time to start investing because you buy here and as you start your investing journey, you're buying all this. And then when it goes back up, you're 3, 4, 5, 10 times richer. Think about this. I'm scared to buy at the top. I understand. But let me tell you something about 2015. I'm not saying past is the future. 2001, bam. 2008, bam. 2015, all-time high. Guess what? Everyone was scared. Everyone was scared. Not everyone. A lot of people were scared. A lot of people were scared. The last 2 times we got here, we crashed, we got it, we shooted through to an all-time high. And people said, I'm scared to buy here because it's 2015. There's a lot of things going on. The 2016 election's coming up. We got Trump, we got Hillary, Obama's leaving office. We've got all these other things. It's an all-time high. All these crazy things are happening. We had stimulus checks, inflation's going. There's a lot of problems right now. We got, Crimea just happened with Russia. We have a lot of things going on. We don't know what's going to happen. I'm scared to do it. I'm scared to do it. The market is up here right now. Those people never got in. You have one of 2 scenarios. Unless you only have money once to put in the market and that's it forever, then yeah, of course you're scared. But if you're going to continue to add money every week, every 2 weeks, every month, every year, whatever, you should have the biggest balls in the world. You should have the biggest balls or ovaries, which are basically inside balls, okay? You have the biggest balls in the world. Because either A, you're buying and the market's going to keep going, or B, you start buying right when the market falls. And you're getting it cheaper than everyone else. There is no lose scenario. Remember, the only people who care or should care about the market as far as concerning their investing, the market levels, is people who are 60 years or older and going into retirement and fixed income. If you are under 60, you should be hoping for a market crash. You should be going to bed every night and say, sweet baby stock market Jesus, can I get a stock market crash this month? Because you're not using that money, okay? If you buy a house and the housing market pulls back in 2 years, you don't give a shit. You don't check the price of your house every day because you're not selling it. You don't care what the price is until you're ready to sell 20, 30 years down the road, or if there's a job or change or something like that. You don't care. You should not care about the market level if you're under 60 years old. You should, sweet baby stock Jesus, give me a market crash so my dollar cost averaging on my reoccurring buy just buys me cheaper shares now because I know the market's going to go back up eventually, and the more it falls, the cheaper I get, so I make more money down the road when I am 50, 60 years old. How many people do you think are going into 50, 60 years old that wish to God they were buying the dip in 2001, 2, 3, or 6, or 8, 9, and 10? There are people out there that cannot retire because they were afraid to buy. Why should the market always grow? An economy can't be infinity expanding? No. But the moment the market starts going down and never goes back up is the moment that your 401k in retirement doesn't matter anyways. You're playing a game against an end of a civilization. As long as our country and our economy is stable or growing, the market will go back up. If you are concerned that the market's going to go down and never go back up, that means the end of the American system is upon us, and your 401k wouldn't matter anyways. Remember, it's not real money. Unless you own a tangible asset, equities and money is just Poof, fairy dust. Okay? You can't walk up to Amazon and be like, hey, Amazon, I own a share of your company. I'm taking a piece of this building with me. That's not how shares work. Okay? Money isn't real. It's just numbers in a computer somewhere. Okay? World can never fail. Got it? No. The moment the world's economy fails, it doesn't matter how much your stocks are worth. You really think that if the global economic system collapses, the value of your share of Nikola or Microsoft or Amazon means anything? I swear to... Those are definitely the feds. They don't want us to hear this. Wait, why do you do my neighbor's yard and not mine? All right, I'm just going to give you guys marbles so we can get past this.